Okay, so this class is definitely focused on individual income tax. So we really haven't talked much about how a corporation or a business that operates in that capacity also has to fill out a tax return. And then in those cases, many of those large corporations, C corporations, for example, those pay their own taxes. So it's like its own person filling out their own 1120 and paying their own taxes, and everything's great. But what about when multiple people own a business together, whether it's a partnership? Here's some other examples. Actually, I'm not going to write them down. They're in your book. Partnerships, LLCs, LPs, S corps, trusts, estates, all that fun stuff. These are what we call flow through, or also known as pass through. Okay, so some of us old school people, we call them pass throughs. I don't know why I just capitalized that. So it would just be a pass through entity as well. So you might see something more like this. Okay. But anyway, basically what it means is that the organization is going to file their tax return, and then it's going to pass through to the three, in this case, three individuals. So I've got Mabel, Loretta, and Margaret. It's a local restaurant, and here's the deal, pretty simple. They have income and expenses. So oh boy, that's really dark. Okay, we have income or revenue, and we have expenses. So basically what we'll do is we'll take those two things, revenue minus expenses, right? And we'll end up with $290,000 as our net income or net profit. So again, all I did was I just subtracted the expenses from that revenue. So what a pass-through entity does, so in this case it would be a partnership tax return. You don't need to remember any of the form numbers, but it'd be an 1165 form, and we'd fill out the tax form for them, and then we would pass it down to each individual, and we would have that income and loss reported right from the K1. So we receive the K1 kind of the same way we receive a W-2. So each one of these, Mabel, Loretta, and Margaret, are going to receive, if I multiply this by 1/3, they're going to receive a K1 that shows their portion. And it could be that they split it differently. In this case, they split it the same. We're going to round this number to 96,667. And so each person would report this on that page 2 of the Schedule E. So a Schedule E, that's page 2, part 2. You might have to go to the IRS website to pull that up so you can see that page number. I should have included it in this video. I apologize for that. But anyway, so each person is going to report 96,667. And this, again, is for each person. So there would be 3 of these. All right, now that's for the income. Okay. They also have some investment expenses that they put together with this restaurant. So maybe they're doing some investments as well. So also we've got investment expenses, $150,000. So we'd multiply that by 1/3. Also divide it by 3, right? Same idea. So each person has $50,000 of investment expenses. Here's what we know about investment expenses. They go on the Schedule A under miscellaneous. So we've got that, or actually not miscellaneous, I'm sorry, other. It's called other. So we could put it under that other deduction at the very bottom, and it'd be $50,000. And I'll put that in here. Other. I don't have a line number on that right now. That's from chapter 6. So, okay, and this last one, this one's kind of not fair. You guys didn't really learn about this yet because we skipped chapter 7, which was about capital gains. However, in just following our objectives of the course, that was not one that we really necessarily needed to squeeze in. So, capital gains are basically sales of stocks, bonds, and other investments. So you either have gains or losses. And in this case, they had both gains and losses. So we're going to net these together. So when I net them together, I end up with a loss of what? $56,000. So I'll put in here loss. And again, they're going to split it 3 ways. So this one also rounds. So it's repeating there. So let's just round it to 18,667. Again, each person's going to get that. And this is from chapter 7. So again, not really fair because we skipped that one, but it's 18,667. Still gives you an idea. This is what a pass-through or flow-through entity looks like. It doesn't pay its own taxes alone by itself. Instead, each category, each amount is figured out on the tax return, and K1s are given to each person. So Mabel would have one, Loretta would have one, and Margaret would have one. It's similar to everyone getting a W-2. And then they take that, they give it to their tax preparer, and they make sure that, hey, this, and this are included on my tax return in the right schedules in the right areas.